Good morning and welcome to today's 10 at 10. So earlier on in the week, we've covered director's payroll, and today we are going to be looking at the director's loan account. So we're going to start off with a bit of an introduction today, get you familiar with what exactly we mean by director's loan account. And then of course, we'll move on to how it actually impacts you in terms of accounts. So firstly, director's loan account, you may sometimes just see referred to as DLA for short. And this is simply cash in and cash out from the business in relation to your director. So directors can lend money to the company and directors can borrow money from the company. Now, when they lend money to the company, this is when the director puts cash in or they pay for a business expense personally. And what this does is it creates a liability in the company. So basically, the company owes the director money. And likewise, the opposite can be said. The director can borrow money from the company, which creates an asset, which means they owe the company money. Now, this one's the much more common occurrence where actually we have a asset-based director's loan account. Now, director's loan account's made up of a few transactions. It's made up of cash in from the director. So this can be items such as the director physically introducing funds to the business, paying business expenses personally. And of course, there's also cash out, which could be derived from the director drawing funds out of the company. And of course, paying any expense claims. So basically, if the company pays for a personal expense, then that's cash out to your DLA. So how does the actual DLA work in the accounts? Well, basically, when you put cash in, you'll create a liability. So you'll create a credit transaction, which means the company owes you money. When you take cash out, it creates a debit transaction, which means it's an asset to the business. And of course, you owe the company money. So when you're reviewing your DLA and your accounts, you want to check whether the overall result is a debit or a credit balance. Now, depending on what system you use, so if you use Xero, if you use QuickBooks, if you just drill into it, it will literally just say debit column, credit column. And if it's in debit, it means you as the director or the director in question owes the company money. Now, we'll explain more what we mean by that. If it's a credit balance, it means the company owes the director money. And the good part about that one is in most cases when the company owes the director money, it doesn't have a cash impact, but we'll look at that in a little bit more detail because that might not always be the case. That might just be for, say, expenses or reimbursements, where actually you're being reimbursed for cash which you've already paid tax on. So that part's important. But what we need to identify firstly is whether it's an asset balance, aka a debit, or whether it's a credit balance, aka a liability. The directors physically owed money. So how do we actually impact the director's loan account in terms of postings? Well, the first one we're going to look at is when you have a business cost, which is paid for by the director personally. So if the expense, the underlying expense definitely belongs to the business, it's invoiced to the business, and the director pays it from personal cash for one reason or another, or a personal credit card, anything like that, then the actual spend gets posted in the same way as it would do normally as a bill. Gets posted to your cost code in your PLL, etc. But the payable element gets paid off against your director's loan account. So the director has paid for it. The director is owed the money. It kind of works in an expense. The director needs to be reimbursed for this. So you might not necessarily do it like this. You might put it through as an expense claim, but this is in case you haven't put it through as an expense claim, you've paid for the cost. This is how you do it in that context. Now, you do get the other way around, where you have a personal cost, one for the director, which is paid for by the business, by which we mean the director has some form of personal expenditure, which the business has paid the cash for. So the actual bill itself is addressed to the director. It's not a cost in the P&L whatsoever because it doesn't belong to the business. It doesn't impact its balance sheet in the same way as well because it might not be an asset. So straight away the bill gets posted to what we call the director's loan account, which means it increases the balance the director owes to the company. Then of course you simply pay off the bill by the bank account from the business account's perspective. So that's how that works. And what happens is it creates this asset, a debit transaction in the accounts where basically the director has essentially drawn those funds out, because that's essentially what's happened. They've drawn the funds out, they've paid a personal expense. That's kind of how it works in this context. Now, the main part about the director's loan account, which is really, really key, is why on earth we should monitor it. So, by which I mean monitoring it. Is it an asset? Basically, does the director owe the company money? Or is it a liability where the company owes the director money? Really important to know the difference, because they have a really different impact in basically how to clear the balance down. And really important to monitor it, because if you do happen to have an asset balance where the director owes the company lots of money, the questions you should be asking is, can the business actually afford to maintain your director's loan account? Basically, do you have enough profits after tax to declare a dividend to clear down your director's loan account? Now, what I mean by this is, whenever a director takes out cash from the business, the important part to remember is the director and the company are two separate legal entities. So if the director takes cash out, it's not actually their cash until the company declares it as a dividend. If the company cannot declare a dividend because they don't have enough profits after tax, or they don't have enough retained profits after tax, they can't declare the dividend in full. And if they can't declare the dividend in full, they can't clear down your director's loan account. Now, that's really important, because if you can't, there are some very, I'm going to say, yeah, I'm going to use the word, there's some big there's some big tax implications of this, where you do get charged pretty high fees for being overdrawn, and it's one of these problems that's recurring. If you don't monitor your director's loan account, you let it spiral out of control, it's going to spiral out of control next year, and the next year, and the next year. We do see it happen. So please do monitor your director's loan account. See what position you're in. If you're too overdrawn, slow down the amount you're taking out of the business if you can afford to. If you can't slow it down, you have to try and find profits in your business to offset this. And it's important to monitor this for not only the company perspective, but also from your personal tax perspective, because any cash you take out will be cash that you may need to report on your self-assessment tax return. And basically, what we're going to do is we've got to declare any dividends, we've got to declare any payroll, we've got to declare any benefits, etc. So just be aware that anything that goes to your DLA, it will impact your personal tax later on potentially. So just keep an eye on it, because actually really, really vital. Now, how exactly do you monitor your director's loan account? I just said we should monitor it, but I haven't necessarily said how we monitor it. So the first thing I will say is, if you've got more than one director, have a director's loan account in your chart of accounts. It'll be a balance sheet account. Doesn't necessarily matter whether it's an asset or a liability, because it will flip in the accounts depending which way it goes. But I'd usually, there's not really a right or wrong way to post the account code. We usually set it in liabilities. But make sure you have director's loan account for director 1, director's loan account for directors 2, and make sure the chart of account name makes it really clear that one's for a different director and one is for the other director, so that we can absolutely clarify who has drawn the cash, who has paid expenses, etc. Because you might find that one director draws out less than the other and vice versa. So it just happens. Now, what we need to monitor is the total combined effect of the director's loan account. So if you do have more than one director, you need to monitor what the overall position is of everyone's DLA, because the company's net profit after tax needs to be higher than the total balance showing in the DLA as a debit transaction, basically as an asset owed. So we're looking for an equity line whereby our total equity is higher than our share capital. So basically, negative equity would mean negative equity with a debit balance showing in the director's loan account means you're overdrawn instantly, clear as day, really, really easy, quick fire check. Check your equity line. Is it still positive? And if it isn't positive, that's a sign that you're going to have an overdrawn DLA and that we need to implement some changes. Now, because of the way we're going to format this week, there's going to be quite a lot of content to cover in directors' loan accounts, etc. So just having a little browse ahead just to make sure I've got my place correct. Just want to make sure. Yeah, I'm gonna probably start with that actually. Sorry about it. There's a lot of content on this, so I'm trying not to overwhelm too much in one day. Trying to make sure it's all spaced out. So the first one, actually, what I'm going to cover today is a little touch of some of the items that a director can actually claim for in the way of reducing their DLA. So we said we've got to monitor it. We want to make sure it's not overdrawn, and then we want to make sure we're claiming for everything we can do. So we might have touched upon this briefly in the past. We do a lot of Facebook Lives where we do touch upon this, but I'm just going to clarify a little bit in a little bit more detail. So the first thing directors can claim for are any sort of expenditures which they have paid for personally, which are actually business-related activity and solely and exclusively for the purpose of the business. So some items such as business travel and business hotels and accommodation, items like that, where it's the business element, you can claim for it. If it's got a personal element to it, you can't claim for the personal element. So if you go away for a week and 5 days you're working on business and 2 days you're working on leisure, you can claim for 5 days for, say, the hotel costs, but you couldn't claim for the remaining 2. So important to identify whether it's business or not. And another one which we do see a lot is directors. You can't claim for all clothing items, and by which I mean we do see instances where directors will say buy a new suit and then try putting it through as a claim, but you can't do that because HMRC basically say you're clothing yourself. How you look is down to you as a personal preference. It's not required for the business unless, of course, it is a uniform with company branding. So please don't get confused between the two. You couldn't put a claim through for a suit because HMRC classes that more as a personal expense, but you could put a claim through if, say, you've got a shirt with branding. That is allowed. So important to know the differences. Now, if you're doing business mileage in a personal car, you can claim for mileage. Now, this is really useful because mileage works out to be really tax efficient. It's one of the most tax efficient ways to get cash out of your business. It's just so efficient, really. So if you are doing business miles in a personal car, please claim for business mileage. Don't claim for the fuel receipt. It's not the same thing. Personal car, you cannot claim for the fuel receipt, but you can claim for mileage. And actually, I'm going to be honest with you now, mileage usually works out more efficient than claiming for the fuel receipt anyway. So it's kind of a good thing that you can't claim for the fuel receipt because the mileage claim is usually much better. You cannot claim for, say, motor expenses you incur. You can't claim for fuel. So if you do a repair to your vehicle, you can't claim for that. It's not business expense, it's personal expense. So it's important to identify the difference. So we're claiming for pence per mile, by which I mean you can claim up to 45 pence per mile, tax-free, which is a really important one, because if you claim over that, all of a sudden it all becomes taxable and needs to be declared. But if you claim up to 45 pence, entirely tax-free. Beautiful. We definitely want to be claiming for mileage. Now, another one that's often forgotten about with directors' loan accounts and expenses is claiming work from home expenses. This one's so often forgotten. A lot of times people just don't realize they can claim for it. But actually, if you're a director working from home, you can claim for some costs of working from home, because during the time you're working from home, you're going to be incurring additional costs. So you're going to be incurring additional lighting. And actually, the way to think of it is almost like you're hot desking. So you can claim for a proportion of costs such as telephones, rent, mortgage interest, not the mortgage capital, just the mortgage interest. And of course, the lighting. So that's the way to consider it. It's kind of like, it's kind of in the sense of hot desking. You can claim for gas, but you cannot claim for water. That is seen as a personal expense, not something that can be claimed for by business. So when we're doing the expense claims, just make sure you're not claiming any personal expenses as a business expense. That's a big oopsie. Do not do it. By which I mean, don't put a claim through and say, well, it's kind of business. It has to be 100% for the purpose of the business to claim for it. Don't just claim it thinking I can get away with it, because if HMRC do discover it, it's disguised income. It should be declared on a P11D, and it's actually reducing the company's profits in most cases, so it's reduced your corporation tax, and you may have recovered VAT incorrectly. So if HMRC do capture it and they do an audit on you and they do backtrack it and disagree with your treatment, they can charge you for PAYE, national insurance. They can potentially charge you for more corporation tax, potentially charge you for more VAT, and they can backdate it several years. So it can work out incredibly costly. So please don't do that. It's a big no-no. Make sure you're only claiming for costs which are exclusively for the purpose of the business. Now, because this all is expense-based, you're wondering probably how it links in with the DLA. Now, the good thing about the DLA is when you're putting through these expenses, you could be taking out lump sums, £1,000 here, £1,000 there. If you put through an expense, you don't have to take the physical cash. I could put through an expense for £50. I don't have to take that £50 cash. I can instead offset it against my director's loan account. If I don't want the cash in small lump sums, it's easier for me to take it £1,000 a month. Now, what that means is I'm reducing my director's loan account. So if I've taken £1,000 and then I put it through a £50 claim and offset against my director's loan account, my director's loan account only changes by £950 in that given month. Now, what this means is when it comes to the year end and I go to declare a dividend, I only need to declare a dividend for that 950, not the 1,000. So it's really important you can offset these against director's loan accounts. And work from home expenses, mileage are a really, really key way of bringing down this director's loan account so that the dividend element is more manageable. So really, really good tip, claim for all your expenses to reduce your director's loan account. Now, I've covered a little bit of the introduction. Now, what we're going to look at in the next few days is director's loan account in a bit more detail. But I hope for now you found this useful. It's given you a bit of a taste for what we're looking for on director's loan account. And thank you very much for joining us today. And if you did enjoy this video and you did find today's video useful, please let us know in the comments. And likewise, if you have any queries, you can also add them in the comments as well. And I hope to see you guys all tomorrow. Thank you very much. Take care. Bye.
Hi, I'm Lisa.
And I'm Harry.
And we are Chartered Management Accountants from Caseron Cloud Accounting Limited.
If you enjoyed this video, please subscribe to our channel for more videos like this.
Click on the link below to join our free Bloody Brilliant Business Bookkeeping group on Facebook, where we are live every weekday answering questions, sharing stories and building profit-generating businesses that put more cash in your pocket.
If you want to learn more or you want to take a deeper dive into any of the topics we have covered, join the Bloody Brilliant Business Club with tutorials, workbooks, cheat sheets and checklists which make it stupidly simple and brilliantly profitable to understand the financial stuff that you hate.
We'll see you there. Bye.
Bye.